For 50 years, every barrel of oil meant bending the knee to the US dollar. It looked unbreakable until Venezuela started selling the world's largest oil reserves in Chinese yuan and cryptocurrency, bypassing sanctions everyone thought were lethal. Now, America's own refineries are starving for Venezuelan crude, Washington's diplomats are quietly reversing policies, and the world's most indispensable currency is suddenly negotiable. If the petrodollar was the world's leash, who just cut it, and what does that unleashed power mean for us? In the summer of 1974, a quiet agreement in Riyadh rewired the global economy. At the table sat US Treasury Secretary William Simon and Saudi Finance Minister Mohammed Abba al-Khail, flanked by American diplomats and Saudi royals. The deal was simple in form, radical in consequence. The United States would guarantee the security of the Saudi monarchy, provide advanced weapons, and offer technical expertise for the kingdom's modernization. In return, Saudi Arabia would price its oil exclusively in US dollars and recycle its vast oil profits back into American financial markets. There was no single treaty, no public signing ceremony. Instead, a web of secret understandings and official agreements locked together security, oil, and finance. Saudi oil would be sold for dollars, and those dollars would flow straight back into US Treasury bonds, bank deposits, and Wall Street assets. Once the world's largest oil exporter set this standard, OPEC members followed. By the late 1970s, every major oil contract was priced in dollars. If a country needed energy, it first needed dollars. If it sold oil, it held dollars and invested them in America. This arrangement created a permanent, artificial demand for US currency. The dollar became more than a medium of exchange, it became the world's ticket to energy. The United States, meanwhile, gained what French officials called an exorbitant privilege: the power to fund its military, social programs, and consumer economy simply by issuing more of its own currency. Foreign central banks and oil exporters snapped up U.S. debt, keeping American interest rates low and flooding domestic markets with cheap capital. From Washington's perspective, deficits no longer carried the usual risks. As long as oil flowed and dollars circled back, the United States could spend beyond its means without fear of a run on its currency. Behind closed doors, American officials understood what they had engineered. The petrodollar system was not just about oil or finance, it was about leverage. The world's thirst for energy became a leash, and the dollar was the collar. For 5 decades, the silent pact underpinned American power, ensuring that any challenge to the dollar was a challenge to the global order itself. Nicolás Maduro should have been finished. In 2019, the United States government declared him illegitimate, froze billions in Venezuelan assets, and placed a $15 million reward on his head. The plan was regime change by economic asphyxiation. Yet Venezuela holds the world's largest proven oil reserves, 303 billion barrels, locked beneath the Orinoco Belt. When the United States cut off access to dollars and to Western buyers, Caracas did not collapse. Instead, Maduro rerouted Venezuela's oil through a web of intermediaries, tankers with switched flags, and backdoor deals. Most barrels ended up in China and India, not paid for in dollars, but through barter, yuan accounts, and more recently, stablecoins such as USDT. Investigative reports tracked cargoes relabeled as Malaysian or Russian crude, slipping past sanctions into Asian ports. The currency flows were just as murky: no dollar wires, no United States banks. Instead, oil for goods swaps, debt repayments to Chinese lenders, and off-book settlements were handled by friendly banks in Shanghai and Moscow. The United States tried to close every channel, but Venezuela's exports kept moving. By 2022, American refineries along the Gulf Coast faced a problem of their own making. For decades, these plants were engineered to process heavy, sour crude, exactly what Venezuela pumps. United States shale, meanwhile, is light and sweet, a mismatch that leaves refiners struggling to produce enough diesel. Diesel is not just another product, it is the fuel for trucks, trains, and tractors. Without it, supply chains seize up. With Russian barrels sanctioned and Canadian supply tapped out, Washington faced a hard truth: it needed Venezuelan oil more than Maduro needed American approval. In late 2022, the United States quietly issued waivers to Chevron, letting it resume limited oil production and exports from Venezuela. The terms were strict: no cash to PDVSA, only oil for debt repayment, but the message was unmistakable. American diplomats returned to Caracas, offering sanctions relief and debt restructuring in exchange for increased output. The same government that once put a bounty on Maduro was now negotiating for his cooperation. Venezuela had done what no one thought possible. It survived outside the petrodollar, trading its oil through a patchwork of yuan, barter, and crypto. The monopoly was broken. Not by a rival superpower, but by a sanctioned state that proved the dollar's leash could be slipped. Every year, the United States Treasury faces a simple equation with no good answers. The federal deficit now runs over $2 trillion, but the real number is even higher once you factor in old debts coming due. To keep the government running, the Treasury must sell nearly $3 trillion in new bonds annually just to stay afloat. The traditional buyers have faded. Japan, once the largest foreign holder, is quietly selling treasuries to prop up the yen. European demand has dried up, their economy stagnant, and their own debts piling up. American banks are already overexposed to government paper. That leaves China sitting on a pile of $750 to $850 billion in United States treasuries. No other single player has the capacity to absorb more without moving markets. Scott Bessent, the Treasury Secretary, understands the danger. On one hand, Washington is threatening China with 60% tariffs, restricting access to semiconductors, and running military drills near Taiwan. On the other hand, Bessent is forced to pick up the phone and call Beijing, asking them to keep buying United States debt. If China stops showing up at treasury auctions, or worse, starts selling, the cost of borrowing could spiral. Interest rates would jump, adding hundreds of billions of dollars to the government's tab, while stocks and home prices would tumble. The math is simple, but the stakes are enormous. The United States' ability to fund itself now depends on the patience of its biggest rival. China now imports more oil than any other country on Earth, over 10 million barrels every day. In 2018, Beijing launched the Shanghai International Energy Exchange, a futures market where oil is priced and settled in yuan. This gave producers a real alternative: sell to China, get paid in yuan, and convert those proceeds into gold if needed. The contract quickly gained traction. By 2025, it rivals Western benchmarks in trading volume, with Chinese state banks clearing and financing these trades in their own currency. But the system goes far beyond a single exchange. China's cross-border interbank payment system, CIPS, now handles more than $13 trillion in yuan transactions each year, processing payments for oil, gas, and other commodities. CIPS bypasses the traditional SWIFT network, reducing exposure to Western sanctions and banking restrictions. At the same time, the M-Bridge project links China's central bank with those of Thailand, the United Arab Emirates, and Saudi Arabia, allowing instant settlements in local currencies, no dollars required. The final catalyst came in 2022, when the US and Europe froze $300 billion of Russia's reserves. Central banks around the world saw that dollar assets could be seized overnight. In the months that followed, the share of global reserves held in dollars fell from over 70% at the turn of the century to just under 60%, with the decline accelerating after the freeze. The architecture is now in place, an entire payment and trading ecosystem where the dollar is no longer essential. China's $60 billion in loans to Venezuela created a financial circuit that runs almost entirely outside the dollar's reach. For years, hundreds of thousands of barrels of heavy Venezuelan crude flowed east each day, not as open market exports, but as repayment for Chinese credit. The barrels themselves, sometimes 500,000 per day at the program's peak, became the currency, bypassing Western banks and sanctions. As United States pressure mounted, more of these shipments settled in yuan or through barter, making the dollar less and less necessary with every cargo. This is not just a workaround, it is a closed loop. Chinese state banks supply capital, Venezuela ships oil, China's refineries and traders process or resell the crude. United States financial institutions are spectators. Britain once financed its empire with global demand for sterling, until war debts and shrinking reserves forced a retreat. Spain's Habsburgs built their power on American silver, then borrowed against future shipments until creditors lost faith. Each time the numbers broke first, ballooning debts, rising interest, creditors diversifying away. Today, the United States government owes over $36 trillion. Interest payments alone top $1 trillion a year, more than the entire defense budget. With fewer foreign buyers and a shrinking role for the dollar in oil, inflation grinds higher. 4 to 6% is the new normal. The arithmetic is inescapable. When the world finds other ways to trade energy, the old empire's bills come due. Today, oil flows and global debts are settled on new terms, often without a single dollar exchanged. As the world adapts, America's financial privilege is no longer guaranteed. The age of no alternatives is over. Now, every nation must decide whose rules they will play by and at what cost.